What is happening, crypto fam? Welcome back to Bitcoin Bulletin, your ultimate source for the pulse-pounding news that's shaking up the digital asset world. The market is moving at lightning speed, and if you're not plugged in, you're missing out on the action. Today, we've got a packed show that you absolutely cannot afford to miss. We're diving deep into the signals that are catapulting Bitcoin to new heights, uncovering the latest on potential price rallies and who's making the big moves. Plus, we're breaking down the surprising shifts in institutional investment and what it means for the future. Get ready, because the crypto landscape is evolving faster than ever, and we've got the inside scoop right here, right now. Let's get into it. First up, our Fed signals the new code driving Bitcoin's epic bull run, pushing prices past $117,000. We're analyzing the macro forces at play and what they mean for your portfolio. Then, we're asking the crucial question: is it time to buy the dip before a massive Q4 rally sends Bitcoin soaring towards $160,000? You don't want to miss this analysis. Next, we're talking about a major shift in traditional finance, as a Florida pension fund makes a massive bet on Bitcoin through MicroStrategy, signaling a new era of institutional adoption. And finally, are Bitcoin whales engineering a price correction, and what does that mean for the market? We're breaking down the latest data and expert insights. Stick around, because this is the intel you need to navigate the crypto frontier. Don't forget to smash that like button, subscribe, and ring that notification bell so you never miss an update from Bitcoin Bulletin. Macro signals now fueling Bitcoin's ascent. The cryptocurrency market is witnessing a significant transformation, with global liquidity and Federal Reserve policy emerging as the primary drivers of price action, superseding traditional on-chain metrics. Bitcoin's recent surge past $117,000, following comments from Federal Reserve Chair Jerome Powell at the Jackson Hole Symposium, exemplifies this new paradigm. This event underscored how macroeconomic signals, particularly those concerning monetary policy and liquidity, are now as influential as technological advancements or network activity in dictating the trajectory of digital assets. This alignment with macroeconomics amplifies volatility, especially concerning liquidity cycles. While Bitcoin and Ethereum have rallied on the back of these signals, other cryptocurrencies show mixed performance. Solana-based tokens, for instance, are experiencing pressure due to weak fundamentals despite some price increases. In contrast, Chainlink is benefiting from increased network usage and strong whale activity, demonstrating that robust fundamentals remain crucial for sustained growth, even when liquidity provides the initial spark. Experts emphasize the importance of projects rewarding long-term contributors and managing treasury deployment in sync with liquidity cycles, prioritizing utility over speculative hype. Looking ahead, analysts anticipate Bitcoin could reach another all-time high by late 2025, with growth rates decelerating, but the bull cycle potentially extending into early 2026. A key factor supporting this outlook is the historically high level of Bitcoin's illiquid supply, which reduces the available selling pressure and creates upward momentum. However, this can also introduce fragility, as a sudden release of holdings by large players into a thin market could trigger sharp corrections. The broader implications for global risk assets are profound. As cryptocurrencies increasingly mirror global liquidity conditions, their performance is becoming more correlated with traditional financial markets. The proliferation of Bitcoin ETFs and evolving regulatory landscapes are contributing to a more stable market environment, potentially fostering prolonged upward or sideways trends, a departure from the traditional boom and bust cycles tied to Bitcoin's halving events. But is this macro-driven rally sustainable, or are we heading for a significant pullback? Stay tuned as we break down whether it's time to buy the Bitcoin dip before a potential Q4 rally. Is it time to buy the Bitcoin dip before Q4's potential $160K rally? The cryptocurrency market is abuzz with speculation regarding Bitcoin's next significant price movement, with analysts pointing towards a potential rally to $160,000 in the fourth quarter. This optimistic outlook is fueled by a confluence of factors, including ongoing institutional adoption, positive macroeconomic signals, and the inherent cyclical nature of Bitcoin's price history. As the market navigates current price levels, the question on many investors' minds is whether now presents a prime opportunity to accumulate Bitcoin before a substantial upward trend. Several indicators suggest that a Q4 rally is not only possible, but perhaps probable. The increasing integration of Bitcoin into traditional financial systems, marked by the growing acceptance of Bitcoin ETFs and a more defined regulatory framework, is laying the groundwork for broader market participation. This institutional inflow provides a steady demand that can absorb selling pressure and support higher price levels. Furthermore, the narrative around Bitcoin as a hedge against inflation and a store of value continues to resonate, particularly in environments of global economic uncertainty. Technical analysts are closely watching key support and resistance levels, with many believing that current price dips are healthy corrections that precede larger upward moves. The concept of buying the dip is particularly relevant in volatile markets like cryptocurrency, where significant gains can be realized by entering positions during periods of temporary price depreciation. The anticipation of a rally to $160,000 is based on extrapolations of previous bull cycles, combined with the current bullish sentiment driven by macro factors and institutional interest. However, it's crucial to acknowledge the inherent risks and uncertainties. The cryptocurrency market remains susceptible to regulatory changes, technological disruptions, and shifts in investor sentiment. While the outlook is bullish, a sudden change in macroeconomic conditions or unexpected market events could alter the trajectory. Investors are advised to conduct thorough research, manage risk effectively, and consider their investment horizon before making any decisions. While the market buzzes with rally predictions, a major shift is happening in traditional finance that could reshape institutional involvement. Next, we're diving into how a Florida pension fund is making a massive bet on Bitcoin through MicroStrategy. Florida Pension Fund bets big on Bitcoin through MicroStrategy. A significant development in the growing acceptance of Bitcoin within traditional finance has emerged with the Florida Retirement Fund substantially increasing its investment in MicroStrategy. This strategic move, involving an additional $6 million investment that brings the fund's total to 240,026 shares valued at $80 million, highlights a growing institutional trust in Bitcoin as a viable asset class. By investing in MicroStrategy, a company known for its substantial Bitcoin holdings, the Florida Retirement Fund is gaining indirect exposure to the cryptocurrency's potential upside while mitigating the direct risks associated with holding Bitcoin itself. This approach is particularly noteworthy as pension funds, typically characterized by their conservative investment strategies, begin to explore digital assets. The Florida Retirement Fund's decision to leverage MicroStrategy as a vehicle for Bitcoin investment reflects a calculated effort to navigate the regulatory landscape and capitalize on the digital asset's growth potential. It signals a broader trend where institutional investors are seeking regulated pathways to gain exposure to cryptocurrencies, recognizing their potential for diversification and as a hedge against inflation, especially when traditional assets yield lower returns. The implications of this move extend beyond the fund itself. When public pension funds, which manage retirement assets for a large number of citizens, commit significant capital to Bitcoin through proxy investments, it sends a powerful message about the asset's maturity and acceptance. This can encourage other institutional investors and public entities to consider similar strategies, potentially accelerating regulatory acceptance and fostering innovation in asset management technologies. The trend suggests a maturation of the cryptocurrency market, moving from the fringes of finance towards a more integrated role in mainstream investment portfolios. Experts anticipate that such institutional movements could not only push for greater regulatory clarity and acceptance of cryptocurrencies, but also spur technological advancements in how digital assets are managed and integrated into traditional financial products. The Florida Retirement Fund's substantial allocation represents a landmark moment, symbolizing Bitcoin's journey from a niche digital currency to a central component of sophisticated investment strategies, aiming for enduring growth and stability in an evolving economic environment. But as traditional finance embraces Bitcoin indirectly, what are the big players on the chain doing, and could they be triggering a market shift? We're now turning our attention to whether Bitcoin whales might be engineering a price correction. Bitcoin whales may be engineering a price correction. Market sentiment around Bitcoin is showing a notable shift, with a growing probability of the cryptocurrency falling below $100,000 by the end of 2026. Traders on platforms like Polymarket now assign a 61% chance to this scenario, a decrease from earlier figures, indicating increased concern over selling pressure from large holders, often referred to as whales. This sentiment has intensified following recent price dips below the $110,000 mark, suggesting that Bitcoin may be struggling to sustain its six-figure valuation. Analysts point to significant whale activity as a primary contributor to this downward pressure. One notable transaction involved the exchange of 22,400 Bitcoin for Ethereum, a move that directly impacts Bitcoin's value and adds to the selling pressure. Furthermore, the derivatives market is showing signs of leverage buildup, with open interest in perpetual futures reaching a two-year high of over 310,000 Bitcoin. Funding rates have also surged, indicating aggressive long positioning, which could lead to cascading liquidations if prices continue to decline. Historical data from 2023 and 2024 shows that similar leverage conditions often precede sharp market corrections. Despite these short-term pressures, underlying demand for Bitcoin remains strong from certain sectors. Corporate treasuries and institutional investors continue to accumulate Bitcoin, with companies like Metaplanet planning significant acquisitions. Corporate treasuries currently hold approximately 632,000 Bitcoin, demonstrating sustained long-term interest. This institutional demand acts as a stabilizing force, absorbing some of the increased supply from whale selling. Some market analysts view these price corrections as a sign of market maturation. They suggest that such events can facilitate a redistribution of Bitcoin supply from large holders to a broader base of retail and institutional investors. This increased distribution, they argue, could ultimately strengthen Bitcoin's long-term fundamentals. However, the success of this redistribution hinges on the ability of new market participants to absorb the selling pressure without exacerbating a downward trend. These market dynamics paint a complex picture of Bitcoin's immediate future. Join us after the break as we wrap up today's top stories with a lightning round recap and our full call to action. And that's a wrap on today's essential crypto updates. We saw Bitcoin's bull run driven by Fed signals, explored the potential for a $160K rally, witnessed a Florida pension fund's massive bet on Bitcoin via MicroStrategy, and analyzed the impact of whale selling on potential price corrections. Make sure to hit that like button if you found this info valuable, subscribe to Bitcoin Bulletin for more market-shaping insights, and ring the notification bell so you're always in the loop. Follow us on all social media platforms to keep the conversation going. We'll see you in the next one.